As much as we would like to see the Fed fund rate come down and also CPI, consumer price index, decrease as well, it doesn't seem like that is going to be happening anytime soon. That's exactly what we're going to be covering in this video, is to get to the 2% target of inflation. The Fed is going to have to hold essentially the rates as they sit today, which means where chances are there is going to be no rate reduction when it comes to the consumer price index information tomorrow, and also the Federal Reserve interest rate decision, both due on Wednesday. So of course, this is going to be coming up tomorrow with how they are going to perform. Now, of course, the news of lower inflation has been in really the news everywhere, driving the S&P 500 index, which we know ETF investors that we are invested in the index itself. We have seen record highs, and we have seen a multitude of record highs, but in conjunction with that, we have seen the 10-year Treasury bond take a very sharp decline. Now, of course, it's a really good rally, but a lot of people are saying that the stock market is really overreacting and it's really oversold at this point, trying to get to that 2% annual inflation that the Fed is shooting for. And of course, looking at March, moving into April, the CPI actually increased, which isn't a good news for the Federal Reserve, because of course, as they continue to fight inflation, if inflation continues to increase, it means we are not going to see a rate reduction. Now, there's a multitude of things that really go into this, and that's what I want to cover in this video, is as they try to hit this 2% target for several months, it doesn't seem, and a lot of economists are forecasting, it might be 6, 12, 18 months before we actually get close to the 2% inflation. But a lot of people are saying that 2% inflation is not really feasible anymore. Now, of course, when you start looking at some of the things that have a big impact on inflation, looking at rent in owner-occupied homes. So when you look at rent overall, especially here, it has gotten astronomically expensive. Larger cities, we've seen the same. The pace of new home construction has slowed down a little bit. And even over the past year, even with the higher mortgage rates, we are continuing to see the prices of homes go up. So think about that for a minute. Now, we were at, 2.5%, 3.5% interest rates on mortgages. Now we're at 7, maybe even 7 plus. We are still seeing the value and the price of homes increase, which is kind of crazy, because when you look at the shelter portion of the CPI, it is up 5.5% compared to last year, which is kind of crazy. So again, we're seeing the price of homes go up, even though the interest rate is over double what we've seen in 2020 and 2021. It's kind of crazy. Now, of course, other than housing, the market, CPI again was up around 5.1%, and this was based on the wage sensitivity. And of course, the labor market may not be really red hot right now, but the economy added 272,000 jobs. Now, I'm really for either party, whether it's the Republican or the Democrats. I really don't take alliance. I really think it is what is best for the nation, because when we start breaking this down and thinking exactly what it looks like under, a former president and a current president, inflation reached 8.5% in March of 2022, which of course led the Federal Reserve to raise the Fed's fund rate. The overnight rate went up, and also the reserves went up to 5.3%. or about 62% of peak inflation. Now, of course, when you start looking at some of this, what President Joe Biden has done is really inflicted into inflation itself. When you look at the Congressional Budget Office, they estimated a federal deficiency of 5.6 this year in 2024. They are anticipating a 6.1% federal deficiency in 2025, which means it is up 4.6 from prior to the pandemic. And of course, they said just for these deficiencies that we're seeing in the congressional budget, it is raising the interest rates about 0.5% to really go on to inflation just because of this. Then you couple it with the climate change agenda, which again, the cost of getting new air conditioners is up thousands of dollars. When you think of the new energy conservation and emission standards, raising the home prices about $31,000. That is right. When you look at the energy efficiency of the homes, when you think of the emissions, when you think of the furnace and the air conditioning, it is raising the price of a home about $31K just off the bat. When we start looking at the price of new homes, even though we're having less homes built, the homes that they are building are exponentially more expensive. And of course, President Biden rolled back a lot of the former President Donald Trump's policies when it comes to immigration. Now, they have allowed around 250,000 immigrants a month in 2023, which of course, looking at the former president, was around 100,000. And the result of this can be seen with the rent in the apartment. with all of the additional workers and people actually migrating to the United States, that is the reason why we are seeing a huge surge in the apartment prices. Apartment vacancy rates are in New York are at a historical low, and they are seeing this almost across the entire nation. So not only can people not afford to move into new homes because they're more expensive and the prices are higher, when you start looking at apartments, and even here, when you're looking at a one-bedroom apartment, you're running about $1,400. A two-bedroom is about $1,850, which is kind of crazy because we're just north of Detroit in Michigan, and the numbers are speaking for themselves. And of course, when you start looking at the budget approval packages for overseas, when you couple in the Ukraine, Israel, and Taiwan, you're adding on another $95 billion. And of course, Biden on top of that forgave $475 billion in student loans, which both of those, of course, are going to add to our federal deficiency, which we know just continues to grow like crazy. Now, of course, there's a couple other things at the end of 2025. The Tax Cuts and Job Act will expire from 2017, which means a majority of Americans will have to pay, unless they change something else, but a majority of Americans will have to pay more taxes because a lot of the tax provisions that we've seen from 2017 are going to be going away. And of course, it says without these going, it is going to raise taxes approximately $4.8 trillion from these tax provisions that are going away over the next 10 years. So think about that. The Americans that are paying all of this money in taxes are going to see $4.8 trillion over the next 10 years. That is going to be increased and spread across Americans that are paying their taxes. Now, of course, it's very safe to assume that really the stimulus to aggravate demand and inflation are really some of the big deficits that we see. Groceries are taking the largest share that we have seen in the last 30 years. The grocery prices have gotten to the point where, again, 30% more expensive, and they are taking the lion's share. And then, of course, when you're looking at wages that are about a 50-year deficiency, catching up to where inflation is, where the CPI is, where the consumer price index and the cost of things are, we are falling behind working that 9-to-5 job. This is the reason when you start looking at individuals that are earning $50,000 and earning $100,000, we are seeing them live paycheck to paycheck. Even when you look at retirees, over 50% of retirees at this point are not saving anything for retirement or do not have anything during retirement or going into retirement, which again is kind of crazy. And of course, you couple that with student loans, you couple it with the increase in rates, the increase in car payments if you're looking for a car, the increase in the cost of a house or an apartment, and your utilities are going up. And even here in Michigan, we have seen our insurance or our car insurance has increased about 30%, which for a majority of people, especially if you are living paycheck to paycheck, you're going to have to come up with another big chunk to cover that auto insurance that you do need on your vehicles. And of course, when you start looking at payments that average about $700 a month right now, it is kind of crazy to think and really open my eyes to see what we're going to see in the future. Now, of course, this is going to be kind of set in stone tomorrow, depending on the meeting, but we're going to see, because a lot of people are saying that the interest rates are going to have to stay put, or worst case scenario, the Fed is going to have to raise interest rates a little bit to try to hit that 2% target, which again, a lot of people are saying the feasibility is not even there, and it's going to be near impossible for them to ever get back to that 2% inflation target. So, all right, guys, so that is going to do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching.